So what is the best way to protect your investments when the market decides to, turn on a dime? It's a question every single trader has to face. Here on The Explainer, we're not going to rely on gut feelings or opinions. Nope. We are diving deep into a data-driven experiment to find the ultimate financial safety net. Look, we all want to protect our capital, right? It's kind of the whole point. In the trading world, that safety net has a very specific name. And as you're about to see, picking the right one, well, it can make all the difference in the world. And that name is a stop loss. The simplest way to think about it is like your own personal eject button. It's a preset exit strategy that yanks emotion right out of the driver's seat. It's the disciplined little tool that stops a small, manageable loss from spiraling into a catastrophic one. I mean, it's arguably the most fundamental tool a trader has. But that brings up a really big question. There are a bunch of different ways to figure out where to place that safety net. So, are all these stop losses really created equal? Or is there one method that just blows the others out of the water? And that is the core question behind the whole experiment we're going to dig into today. It's a straight-up, head-to-head competition to find out which type of stop loss really, truly gives traders the best edge. So let's meet our 4 contenders. First up, we've got the pips method. It's simple, it's a fixed line in the sand. Then you've got the percent method, which is all relative to your entry price. Third is ATR. This one's adaptive. It actually widens or tightens your stop based on how volatile the market is. And finally, indicators. This is the tactical approach, using complex calculations to find a really strategic exit point. 4 very different philosophies, all stepping into the ring. Now, to find a real winner, you can't just guess, right? You need to do it right. You need a big, rigorous, large-scale experiment. And that is exactly what happens here, a methodical process designed to stress test every single one of these contenders under the exact same conditions. So here's the 4-step battle plan. Step 1, generate 1,000 unique trading strategies for each of our 4 contenders using S&P 500 data. Yeah, that's 4,000 strategies in total. Step 2, retest every single one to make sure the performance is valid. 3, export all of that juicy data. And finally, step 4, analyze it all to find a statistically proven winner. Okay, so now for the fun part, the analysis. This isn't just about finding the best performer in one go. It's more like a detective story, a methodical process of elimination where we let the data itself tell us which methods just don't make the cut. And the very first results are in. And wow, this chart tells a really clear story right off the bat. You can see 3 of our contenders, percent, ATR, and indicators, are all making money. They're in positive territory. But just look at that first bar. The pips method is all by itself the only one to produce a net loss across all 1,000 of its strategies. Okay, so pips looks pretty bad. But with any data, you gotta ask the big question. Is that difference actually real? Or could it just be a fluke? A bit of random chance. We need a way to know for sure. So to settle this, we bring in the judge. And in this case, the judge is a powerful statistical tool called the Kruskal-Wallis test. Its entire job is to look at these groups of ours and tell us if the performance differences we're seeing are legitimate or if it's all just random noise. And here's the key to reading the verdict. The test gives us something called a p-value. You can think of it as a kind of flugometer. If that number is really, really low, the standard is below 0.05, it means, hey, this is no fluke. The difference you're seeing is real and statistically significant. And the verdict is p equals 0. 0.000. I mean, you literally can't get any lower than that. The difference between these methods isn't random. Not even close. It is extremely significant. So what does that mean? It means we can say with a ton of confidence that the pips method just isn't cutting it. It's statistically the weakest performer here. So, it's out. Officially eliminated from the showdown. All right, so now we're down to 3. The test gets run again, this time just on percent, ATR, and indicators. And guess what? The p-value, once again, is way below 0.05. This tells us that even among our profitable contenders, one of them is performing in a way that is significantly different from the others. We know there's a standout in the group, but we don't know who it is yet. To find our standout, we need one last clue, the z-score. Basically, the z-score tells us how much a particular group stands out from the crowd. A big, positive z-score is like a giant flashing arrow pointing right at our overperformer. And the winner is the indicator-based stop loss. It had the highest Z-score by a country mile, proving that its superior profitability was the real deal. When it comes to pure profit, this is our champion, hands down. But hold on, hold on. Profit is only half the story, right? A truly great strategy also has to manage risk, and let's be honest, the stress that comes with it. So our winner now has to face one final test: profit versus pain. This final test measures something called maximum adverse excursion, or MAE for short. It's a bit of a fancy term for a really simple, powerful idea. What was the biggest paper loss your trade was sitting on before it eventually closed? It's a direct measure of the risk and, frankly, the psychological pain of a strategy. To put it another way, MAE measures your maximum uh-oh moment. Come on, we've all been there, staring at the screen, watching a trade go deep into the red, your heart pounding, wondering if it's ever going to come back. A strategy with a lower MAE is just way less stressful and generally a whole lot less risky. So they ran the statistical analysis again, but this time focusing entirely on those uh-oh moments. And the result? It was just as crystal clear. The indicator-based method didn't just win on profit, it also won at managing risk. It delivered the best returns with the least amount of pain along the way. So we have our winner. But the real story here isn't just about which stop loss is the best. It's actually about how we found that answer. It's about the power of the process itself. Let's wrap this all up. What's the big takeaway? Well, first, the indicator-based stop loss was the undisputed champion, winning on both profit and risk. But honestly, the real hero of this whole story is the scientific method. By replacing assumptions and guesswork with meticulous, data-driven testing, it's possible to turn a simple hunch into a genuinely informed, superior strategy. And that really leaves us with one last thought. This whole process of testing, measuring, and making decisions based on cold, hard evidence, that's not just for trading. So I'll leave you with this question. What important decisions in your own life, in your career, your personal projects, could be totally transformed if you left the guesswork behind and adopted this kind of rigorous, data-driven approach?